Wint is a fourth-generation resident of Lawrence, Kansas. His wife, Mary, is a former math and religion teacher at St. John's Grade School. They have 3 daughters and 7 grandchildren. He graduated from the University of Kansas in 1975, where he was a varsity football letterman. So this is something I didn't know. And he graduated 4th in his class from the KU Law School in 1978. He's been a partner in the Lawrence law firm of Stevens and Brand since 1978, and he was managing partner there for 3 years. His law practice has varied and included businesses, personal injury litigation, real estate, development law, bankruptcy, divorce law, and estate planning. He served as Douglas County Councilor from 1998 to 2000. From 1982 to 1992, Wint served in the Kansas Senate, where he was vice chairman of the Ways and Means Committee and chairman of the Judiciary Committee. He's involved with many charitable organizations, including currently sitting on the United Way board, and we're very grateful for his presence. So it is my pleasure to introduce Wint Winter to all of you today.
Thank you, Cornish. I try not to exaggerate my accomplishments, but in this case, Cornish, you've exaggerated them for me. Makes me wonder about how I got all through that. But anyway, good afternoon. And thank you for joining us. I've got my advertisement on here for my mask for United Way, so don't need that. So the agenda sort of goes through quickly kind of what we wanted to try to accomplish. In a phrase, what we want to try to accomplish is to help you all as executive directors, and some of you I'm sure are sitting in are board members, volunteer board members, to first of all reassure you as board members about your opportunity, your ability to serve on the board without worrying about having personal liability. That's a big deal. We're always trying to recruit really top-notch board members. And for many of us board members, of course, it's a question of time commitment and concern or worry about liability, et cetera, et cetera. So what we want to try to accomplish at the end of this little session is to arm you all with some documents and some knowledge so that this will help you recruit and retain really good board members and then have them help you as an executive director with your job, remembering all the time about trying to make sure that directors are reminded about what their job is and frankly what their job isn't. So we'll talk about board member liability. We'll talk about a couple of case studies. We'll go through a short presentation on the legal principles of nonprofit directorship and obligations of directors. We'll then take a little deeper dive into probably the area that is perhaps the most important for directors, and that is how do they understand and what do they do with these financials? Because most of us break out in hives when we think about looking at financial statements. I don't think there's any, certainly I wasn't born being comfortable with financial statements. I had to take, you're listening to a guy who had to take Algebra 2 twice at Ottawa High School because I didn't do such a good job my first time. So numbers are not a real affinity for me. But I think part of the job of us as directors and executive directors is to remove that intimidation factor from board members, and so they can easily focus on the stuff that's really most important. Because let's face it, all of us in the not-for-profit world are in it to make society better. And if we go broke, there's no way in the world we can make society better. So we have to make sure that our board members are monitoring the right things and reacting in the right way for our financials, so that we can be healthy and ongoing as charitable providers. Finally, we'll take a look at a proposed director commitment to serve and conflict of interest policy, and then we'll leave you with a few other documents. Feel free to, you can either, if you have questions that come up, you can either raise your electronic hand or and then send those to Leah, or you can wait till the end and you can ask them live at that point in time. So Leah, if we could, let's go to the slide. You could put up the presentation. And there you go. Leah is going to be the technician flipping through these things. So I'll try to remember to ask Leah to when to change slides. So the next slide really kind of talks about the 4 basic principles of state corporation law. Don't fall asleep on me when you hear the notion we're going to talk about some law. But there's really 4 basic principles that apply, duties, responsibilities that apply to directors of any corporation, for-profit, not-for-profit, etc. First thing is to remember that all the authority for decision-making and oversight belongs to the board of directors. Decision-making as to matters of policy and direction and strategy and governance, and then oversight as to matters crucial to the health of the organization, especially picking, interviewing, and hiring the right executive director, and then supporting and challenging that executive director. That's probably the most important job, in my opinion, of a board of directors, is doing a really good job of recruiting, interviewing, hiring an executive director, and then asking the executive director consistently at every month's meeting, what can we do as a board to help you have the tools to do your job? That's a pretty simple question. And in my way of thinking, that question really boils down the director's job. Directors need to direct. They should not manage. They should not get involved in day-to-day operations. That's for the executive director. Sometimes I know we have certain board members, or maybe even whole boards, that want to micromanage, nitpick the executive director. And I would tell board members, that's actually a good way to increase your liability by taking over the job of executive directors. So I mean that in a way which should be supportive of all of you that are executive directors, admonishing your board to work really hard at interviewing and hiring the best executive director you can find that fits with the mission, and then giving that executive director the support that he or she needs, both financially and from a big picture standpoint. Now, that's not to say the board members shouldn't challenge from time to time. Oversight means oversight. But that I would say is if there's one thing to take away from this for directors, it is remember your role, stay up on the top floor, do not get involved in the weeds, and support and challenge your executive directors. The third item, second item is that boards only function through a majority of their board of directors. I know some of us have a difficult time sometimes even getting a quorum into some of our meetings. If that's happening, it's not right. You should ask your board president, chairperson, to help make sure that there's a quorum there. And not having operating kind of consistently without a quorum is a bad idea and actually can lead to potential liability. The third area that we'll talk about in the future here is conflicts of interest. Believe it or not, they can come up without bad faith. They can come up without people thinking about, gee whiz, I want to get some money from my service on this board. But being sure the board is acting arm's length is really, really important. Finally, I mentioned to you that, in many ways, board members, potential recruits for boards, don't have to worry or shouldn't worry about legal liability. And that's because for two reasons. Number one, the standard of care is really not that difficult. We'll talk a bit about that, more about that in a minute. It's not that hard as a board member to do your job. Basically, show up, be informed, and just exercise common sense and logic. Secondly, and perhaps more importantly, the Kansas legislature, along with a lot of other legislatures in the country, about 20, 30 years ago, passed a law that provides that directors and volunteers, this does not apply to paid staff, but directors and other volunteers of Kansas not-for-profits are not liable for damages. There is no personal liability for board members unless they're, number one, the board they serve on does not have liability, directors and officers insurance coverage. So if your agency does not have that kind of coverage, I would talk to the board and make a strong suggestion that they buy that coverage. That's a key, one of the two keys for them to protect themselves against any personal liability claims. And the second caveat is board members can be held liable if their conduct rises to that very, very bad level of being willful or wanton or intentional. You can't fish off the company dock, for example, in conflict of interest. So bottom line, no liability under Kansas law for directors, as long as the organization has directors and officers liability insurance, and there's none of this really bad kind of conduct. The next slide talks about the role of the board, and I'll just hit a couple of key things. We already talked about the role of the board is to provide direction, granting authority and setting limits. That's important to remember, again, that back to that framework of not being detailed, not being micromanaging, provide general direction, granting authority to your executive director and your other officers, and set limits on those folks. There's a couple of local examples here that I want to bring up without using specific names that sometimes have in the past caused people concern. Just Food, as many of you may remember, some years ago was caught up in some public bad news. The then executive director ended up being accused of not properly filing the tax returns, 990s, and then not paying trust fund taxes, not paying to the state and federal government the employment taxes for employees. And I remember very vividly one of the board members walking into my office and saying, gosh, can I talk to you? She was literally white. She said, I just got out of a meeting with some other directors of Just Food, and the IRS told us that the organization had failed to pay these employment taxes to the tune of more than 6 figures. And they told us that under federal IRS rules, even for a nonprofit, the directors can have personal liability for those unpaid taxes. The IRS is serious about that. I won't go in, and I think you all know that the board of Just Food jumped on this, got a new executive director, did a lot of great fundraising, solved the problem so that the IRS did not have to try to impose personal penalties on directors. But in that case, I think what happened was, without the board's knowledge, the executive director may have changed some of the accounting that was done, may have dismissed, without the board knowing it, the outside accountant, and was allowed to operate on his or her own without review by a third-party outside professional accountant. And what happened was, you know what? So it's important for board members to ask questions, to be making sure that you've got the right third-party accountant, that there's an auditor. Sometimes nonprofits must have an external audit. Sometimes they don't have to have external audits. But board members, smart board members, are members who make darn sure every month that the financials are prepared by external accountants, not in-house, and that from time to time, at least once annually at least, there's an outside audit. The other example is Heartland, and I think many of us know that Heartland parted ways with its longtime executive director a year plus ago. And in that case, without getting into the specifics, I think it may be a situation where the executive director maybe didn't stay close enough to his or her board. It's important for you executive directors to be sure that you understand what the board wants from you. Keep the board informed, especially about anything that might be accused of being any kind of self-dealing. So executive directors not only have to be sure to inform their boards, but stay close to your boards. Be sure that you're not just taking over without them knowing what's going on. You have to have that right distance with the relationship between the executive director and the board. So the standard functions of board members are, as I said before, decision making as to policy, and oversight as to other matters, particularly oversight with respect to conflict of interest matters and so on. And the board has to be sure they're protecting the assets of the organization. Under law, the next slide talks about the basic legal duties of directors. And by the way, you have or will have these documents that you can share if you'd like with your board members. The first duty is a duty of care, and that's simply the care that an ordinary prudent person in that same position would use. Board members do not have to be experts in any particular subject. They just have to be kind of ordinary in their care. Just be prudent and ordinary. We're not asking, the law doesn't ask board members to be geniuses in any particular area. Just basically be informed. It's not that hard. But that will get us to kind of the expectations of board members. Show up, ask questions, be sure you have outside accountants, understand the financials, etc. And then the second big one is a duty of loyalty. And that basically means act in good faith in the best interest of the corporation. A duty of loyalty can be violated if the board allows itself or any one member to have conflicts of interest in hiring or any kind of relationship where a board member ends up being paid something. Just basically can't do that unless you follow strictly the conflict rules. Key areas of the board's oversight, I'll just hit again. Hiring and oversight of the executive director. That's very, very important. Accuracy of the financial statement, as we mentioned about the just food problem. Be sure that the financial statements are accurate and people understand them. Next slide. Just to sum up, you might think, well, our little agency doesn't amount to much, but as these figures show, there's more than 1 million non-for-profits in this country. They have, 3 or 4 years ago, a study was done showing at that point in time they had more than about 14 million employees and $1.5 trillion of revenue, but also suffered fraud losses of $77 billion. So fraud losses in nonprofits are rampant, and sometimes that's just because board members aren't taught about how to read financials and don't ask the right questions. And as is noted on this, there is no such thing as being too big to fail in the nonprofit world. You might remember the sex abuse scandal at Penn State University, and the board of directors had to issue a statement, and I'll read it. It says, "We, the Penn State Board of Directors or Trustees, failed in our obligation to provide proper oversight of the university's operations. Our hearts remain heavy, and we're deeply ashamed. Do not allow your board or yourself to get in that position. It can happen. It has happened. And even organizations as big and powerful as a university board of trustees allows it to happen." Let's go on next to the next PowerPoint. This one goes in a bit more into understanding financials. So we'll take a look at this. First slide here just talks about stuff we've already talked about. This might be this is a good slide for your prospective board members. Again, there's really 3 things: duty of care, be diligent, be ordinary. We're not asking board members to be experts. Secondly, be loyal, act in good faith, and do not allow personal conflicts of interest to jump in. And finally, another way of saying loyalty, duty of obedience, adhere to the mission and policies of the organization. The board always ought to be reminded about what the mission is. I know some organizations start their meetings of boards with reading the mission. It's a very, very good idea. It may seem kind of trite, weird, but taking 30 seconds to read the mission statement of the organization before every board meeting is a really good way to remind your directors, this is important stuff that we're doing. And so consider that. The next page talks about 10 basic responsibilities of boards. I won't go over all of them. We're going to focus on just 2 of those. The board needs to ensure adequate financial resources. That's that question I suggested that board members always should ask you, executive directors. Is there anything else that we can do to support you? Do you have all the resources you need? Financial, human, etc. And then secondly, protect the assets and provide financial oversight. Next slide. We're just going to look here about some specifics about financial management that is really I think the biggest challenge of boards is taking the time to read every month and go over every month the financials. I would say, I've said to some executive directors, if you're not comfortable, if you don't really understand the financials, then stop. You must get some basic training in financials. It's not that difficult. There's a lot of buzz that goes around. What's a financial statement? What's accrual? What's cash method? That stuff really is not that hard if you keep it simple. And then being sure every month or every if you have quarterly meetings, whatever, the board ought to be looking at the financial results against an approved budget and versus last year. If your agency does not have an approved budget, there's something wrong. Every single agency annually should have a budget. That's your mark. Those are your goals. And your board ought to be looking, and you ought to be looking every month to be sure, are we on track with that budget? Are we ahead? Are we behind? What's that mean? Let's go to the next slide, Leah. So I've touched on this before. Review the annual budget, ensure the filing requirements are up to date. That's the Just Food problem. They did not ask enough questions, and the filing requirements simply were not up to date. Tax payments were not made, allegedly. The board you ought to be sharing your 990s with the board. 990s are, of course, the annual report that nonprofits are required to make. We share those with the board. Next slide. Two primary oversight responsibilities. This is somewhat repetitive. Review and understand the financial statement. A lot of board members I've seen act like they understand the financials, but they sometimes really don't. Do not allow your board member, don't assume your board members know. Assume that they're like me, that they flunked Algebra 2 and had to take it twice. And then again, your board members should be comparing current results versus budget in last year's. The next slide just underscores a few other things. They ought to make sure that the financials are timely. Sometimes CPAs, accounting firms get behind, and maybe they're going to have to decide whose financials they do first. Well, and that sometimes means, our financials are not done yet. Sorry, board. We don't have our latest financials. Don't let that happen. Be sure that your external financial people are keeping up to date. Set a standard that you get to them the information they need by X date, 5th or 6th or 7th of the month, and they always will get you the financials by Y date, the 10th, the 15th, the 18th of the month, so that every month, without fail, those financials are in front of your board. And then make sure that there is a segregation of duties. You all have the obligation, obviously, to keep internal records about all your receipts, all your expenses, to pay the bills, and make sure that you've got the proper separation of duties, and your CPA or accountant can help you with what that means. And then that last one just touches on what I mentioned before. External auditors are important. The next slide talks about 3 different types of documents or parts of financial statements. First, there's the income statement. It's very simply what you brought in and what went out. How much cash came in and what went out. That's and we'll hit, though, in a minute, an anomaly about that. The balance sheet is the third item, and that's simply what we owe and what we own. What's the value of what we own? And that might be just computers and pencils and desks. It might be real estate. It might be investments. But that's what the balance sheet shows: how much you owe, and then how much, what is it that you own and what's it worth. The thing to watch on balance sheets is that so-called equity line. Is that going up from time to time to time, from month to month to month? Is the net of what you, hopefully it's a positive figure, of what you own less what you owe, is that going up or down? If it's going down, that's a red flag. The next slide really touches on the same thing, so we can flip by that. Let's go to the next one, Leah. Reviewing the income statement. On the revenue side, again, we talked about the income statement. That's what you brought in minus your expenses. So key question, first of all, obvious, is revenue more than expense? If it is, then you are growing your income and you're growing your balance sheet at the same time. Or are expenses exceeding revenue? And then we'll talk in a minute about what is revenue. It's also very important to identify the more or less funds coming in than are budgeted. Your budgets should have the expected revenue coming in every month, every quarter, and the executive director and the board members should always be wanting to know, is it more or less? And by the way, I think it's a very helpful management technique for executive directors or bosses to share the income statement, the financials, with your staff. I think open book management is really, really important. And I know from past experience that employees and staff really appreciate it if they know, how's our company doing, how's our agency doing. So consider that, and that would take you every month to have a meeting and or send out an email or what have you, letting your staff know how things are going. The next slide talks about the other side, sort of the bad side of that income statement, the expenses. Things to check are, is there a significant increase or decrease in expenses compared to budget and compared to the year before? And if there are significant increases in expenses, why? What can you do to lessen that reduction? Or what can you do if you can't lessen it? How are we going to survive? Are you going to raise more money? Are you going to dip into your endowment or reserves? The balance sheet, the next slide, goes into a little more detail on the balance sheet. The assets typically on the balance sheet start off with what's typically called current assets. That's mostly cash, and the amount in your checking account, et cetera, et cetera. That's really important. The liquidity that you have, how much can you write checks for? And then if you have investments, what's your investment policy? How risky are those investments? What's the financial return year to year? And then one thing for the board to be sure that it's asking and can be sure about, are the debts, are you paying your monthly obligations when they come due? The first thing that people get when cash flow gets tight, I know we all think about, oh, well, I'll just solve this by not paying my rent this month, or what have you. Your board ought to be asking you to be darn sure that you're paying all of your obligations as they become due. If you're not able to, face into it. But the current liabilities, on the asset part of the financial statement, those are what the board should be looking at to be sure that those aren't going up. So we can skip over the next one, Leah. That exercise you could do. It's really repetitive of where we were before. The next slide, the next two slides actually talk about a phenomena on the income statement that's important. And it relates to organizations that have investment assets, endowment funds. They have excess funds that maybe over the years the agency's raised and saved, and that you've invested. Some financial advisor, for example, has invested for you in marketable securities, Wall Street stuff, etc. That's a very good thing. An agency that has been fortunate enough, whether it's to receive bequests from people in their wills, or has been able to raise money and save it from year to year to year, that's a great thing. But it also can be tricky, and here's why. In the accounting world, on the income statement, take a look at this one. This is an income statement from a company, and you see there the line that says at the top, it says other income. Well, and then it says net unrealized gain / investments. That in that month, it shows $40,824. That in that case is the dollar amount of the increase in the market value of this agency's investments. So every month, your accountant will be looking at the value, the market value of your investments, as shown by Wall Street, quote unquote. And then identifying that, what's the increase or decrease from month to month. In this case, in August, this company had a $40,000 increase in the value of its securities. That's a lot of money. That shows up under net income. That $40,824 is part of your net income. However, you can't spend it. It's not cash unless you sell all those securities. So let's say you had these investments were in a Schwab account, and Schwab was investing in a variety of different stocks and bonds and so on and so forth. Well, if in that month the value of those goes up, then that increased value is captured and treated as if it is income. So if you turn the page, we'll show you the problem with that. This page shows at the bottom, you'll see net ordinary income. Net ordinary income, to simplify, means basically cash. Well, what's the real cash revenue I got in? And not including this unrealized gain in your investment assets, and less all your expenses. This agency, in its so-called net ordinary income, showed a loss in this particular month of $41,359. Think of that as ordinary income and ordinary operating income as sort of the day-to-day recurring work of your agency. A loss of $41,000 in 1 month is quite alarming. That could be a big problem. Well, if you're looking at the financial statement and your eyes just go to the bottom line, net income, the net income only shows a loss of $3,251. That's not something people are going to get too uptight about. But the problem with that is that net operating loss of $41,000 is being masked or hidden by this unrealized gain in net income. And with the stock market, the past 6 months going up and down, crazy up and down, what that means is this particular agency cannot continue to survive will not have the cash to survive unless it starts liquidating and selling down its investments. Where there's a month, which is the opposite, where the stock market value's gone down instead of up, well, you're going to show an artificial net income loss. So that's just a cautionary tale for even the income statement for your financials can tell a very incomplete story. Next, skip over legal responsibilities. We've really gone through that. Duty of loyalty, duty of obedience, etc. The last document we have here, we mentioned the duty of obedience, the duty of loyalty. Well, the duty of loyalty is violated probably the most. You have to be loyal to your organization, to its missions, and you can't let your own personal interest get in the way of your loyalty to the organization. This form is actually recommended. It comes from the organization Board Source, which is a national organization that helps boards, nonprofit boards, with governance issues. I think probably very few nonprofits locally ask their directors to sign a commitment to serve. But I would recommend that you share this with your board chairperson and seriously consider having the board ask all of its members to read and sign a commitment. It's really pretty simple. It isn't so much that, in fact, it doesn't add any burdens or responsibility to the members. It just helps those members realize and communicates to them, hey, this is serious. We treat our organization and our mission very seriously. People in need in our community rely on our organization. So please accept your job as a director in a meaningful way. And there are a few things we do expect. And I'll just hit the highlights. Number one, it says I will make my attendance at meetings a high priority. And my goal is to be at meetings at least 50% of the time. And if I don't hit that mark, then I agree to submit my resignation. If you don't have a board member that can come at least half the time, then they really ought to be asking themselves about why they're on that board. Secondly, they're pledging to come prepared. Take 15 minutes before the board meeting and take a look at the financials, the agenda, etc. Third, they say they'll know what the budget is, and they'll review and approve the financial reports. Next, they're saying they understand the conflict of interest policy and they'll follow it. Second page, you flip, Leah. This is an important one for you executive directors. Note, it says, I will refrain from intruding into administrative issues that are the responsibility of management and staff. That goes back to what I've said all along is I think the critical job of directors. Do not micromanage. Hire a damn good executive director, give them the resources they need, and stay out of their way. So this is kind of a standard that embodies this. We're asking these board members to put in writing, yep, I'm going to refrain from micromanaging my executive director and staff. And the next one says, hey, even if I am in a losing position of a vote, there's a vote on some matter, comes before the board, there's a split vote. And this says, even if I voted against it, I'm in the minority position, I'm still a team player, I'm with us. And then it says, I agree to participate in strategic planning, self-evaluation, etc. So then the second part of this is a conflict of interest policy. I think it's particularly important that all board members are given the policy, that the board obviously first needs to adopt a conflict of interest policy. and then follow it. It's not that hard. Yeah, and it really applies to if there's a member of your board that, for example, might be in the lawn maintenance business, and they say, "Hey, I want to do the lawn maintenance for the organization." That's nice, but the board cannot do that in the absence of competing bids from other unrelated organizations. And if it is approved, that board member who is possibly going to get hired cannot be involved in the discussion, has to leave the room, cannot lobby. And again, I would always tell boards, if you're thinking about hiring a board member, buying something from the board or whatever, then do yourself a favor, get a couple of competing bids, and if your board member has the best bid, then great, hire them. That's really it. You can read the rest of it. The other documents, which Leah, I think you already shared or will share, that I'm just going to let you look at, or from Board Source, board member agreements. This just talks about why it's a good idea to have board member agreements. The next document is a board member self-evaluation. This is for board members to use to evaluate themselves. That really helps you as executive director and your chair to impress upon board members how they should be behaving. And then the last one, you've probably seen these, the board members self-evaluation for the board as a whole. You should be asking once a year each of your board members to fill this out. How do they think the board's operating? So that's, I hope that's been helpful. The main points here are you can easily, in recruiting board members, you can easily assure them that there's virtually no chance that they'd be held personally liable. That should help you recruit board members. Secondly, the board should mostly pay attention to having a darn good executive director, being sure that the executive director and the staff have the money and the policies they need. Yes, double check that the board, the director is hiring the right outside help. And then boards, stay out of the way of your executive director. Support them, encourage them. Remember that their job is really, really hard. And finally, consider, make sure, I think it's important that you as the executive directors and board members really be sure that you're spending the right amount of time every month on the financials, and you're being cold-eyed about those. If they show bad news, then react to it. Don't try to cover anything up. Don't try to click your heels 3 times and think that this is all going to go away. Grab a hold of those financials, understand them, and move on. Leah, I'll turn it back to you. Any questions anybody has?
So there's a question in the chat from Mike H. A lot of conversation surrounds financials. I'm currently on a board, but I've heard way too many horror stories of incoming or sitting EDs that make the work environment toxic or harmful to staff. What obligation does the board have to the safe work environment of a nonprofit? What can a board do in the case of an ED that is bringing in financials, but is ultimately harming the safety of the work environment of the organization?
That's a great question. That goes in over the banner of the oversight of the board. The board has to provide oversight. Obviously, the first question that comes up is, gee whiz, it sounds like maybe the board didn't hire the right person. Maybe at the time they were the right person, but now they're not. So the board absolutely has, the organization certainly has liability if the executive director, as supported by the board, is not providing a safe work environment, whether that's physical safety, emotional safety. That's a big problem. So board members really need to have their eyes open, and every organization should have a way, and this really goes to kind of sexual harassment policies. There ought to be always a way for anyone who feels like they're the victim of any civil rights violation, any sexual harassment violation, for example, to have multiple ways to report that. And if they don't feel comfortable reporting it to the executive director, then there needs to be somebody else inside the agency or outside, a lawyer or a board member who's always available to receive and react to those concerns. Good question.
Are there any other questions that folks have for Wint, either verbally or you can type them in the chat? I don't see any additional questions, Wint. I did want to just highlight from the last question that sometimes the ED or CEO puts very strict barriers or boundaries between the staff and board. And just to highlight what Wint said in terms of there should always be an outlet for staff to reach out to the board, even if staff aren't included in meetings or have a direct line of communication.
Yeah, one really great way to do that, Leah, the best organizations have annual 360 evaluations. The board should, of course, be evaluating in writing the executive director every year. And from my way of thinking, you can't really evaluate the executive director unless you get feedback, confidential feedback from that person's staff. So sending out to staff once a year a confidential questionnaire that asks them to assess and rate their boss is really important. And so boards, the real message in my feeling is to remember being on a board is kind of a contact sport. It's not just a spectator sport. Boards cannot sit by and just twirl their fingers and thumbs and say, "Oh, we got an executive director. That's great." Not catch up. You don't want to be just food. You don't want to be caught not having asked those questions and making darn sure that the ED is doing their job, including being open to staff. The component with regard to board relationship with staff is, on the one hand, you got to be sure that you're not inviting staff to run to board members with every little complaint, every little concern, etc. They first have to be going to their up the chain of command unless they feel unsafe in doing so. But board members absolutely need to be an outlet. If a staff does not feel safe or feels embarrassed in reporting up the chain of command, then the board needs to make clear to those folks, if that's the situation and you don't feel safe or proper going to somebody above you, come to me as board chairman or what have you. And then it's a matter of judgment for the board chairman about what to do.
Thank you, Wint. Another question came in, and we have a few minutes left. Are there a list of reputable CPAs/accountants in Douglas County that have experience with nonprofits? This is something that comes up just about every year, and us at the United Way have been talking about that could benefit from some sector collective bargaining. But would you like to address that question about CPAs?
Sure. Like all of us, we all have our favorites on that score. I'm not going to tell you my favorites are, but I'd be glad to work with United Way to put together a list of folks that are experienced without rating them. I think if you can afford it, hiring a CPA that is a certified public accountant is, as opposed to a bookkeeper, is an extra layer of protection. It costs a little more typically, but the CPAs are supposed to be, anyway, held to a higher standard. So I'd start with, if you can afford a CPA, start with somebody that's got those initials behind their name. That, of course, isn't enough, but there are plenty of good quality CPAs. Some of them will, and I always think, if you're a nonprofit, ask if they have a nonprofit rate. Hint, hint. How about not charging us the full boat? So I'm glad on a confidential basis if people want to email me to pass out some names.
Thank you, Wint. And if you are able to create that resource list, it sounds like it would be really beneficial to folks.
Okay.
There's one last question. When should a nonprofit separate their endowment from the operational side of the organization? Separate EIN, accounting, etc.?
I would first say that depending on just exactly what the board wants, it's not at all necessary to separate the endowment. Most organizations of modest, smaller size that we have in Douglas County don't need to go to the hassle and trouble and expense of creating a whole separate entity with a whole separate set of accounting rules. And if an organization is fortunate enough to say over 15, 20, 30 years to have little by little created a fund of, let's say, $1 million that is not necessary to operate on a month-to-month basis, then a really good way to create a Chinese wall around that is simply hire an investment manager and have that person invest that $1 million in a mixed set of assets to provide long-range market return and some emergency liquidity. You always want to be able to grab hold of that money if you have an emergency. So I think that it's really not necessary to separate that. I think it's important if you have that situation where you have, in that example, $1 million that you don't typically need to dip into on a regular basis, then the board can and should adopt an investment policy that says, among other things, that money will be reserved and will not be available for the executive director and anybody to transfer into the normal operating account unless it's with a full vote of the board of directors. That is a great way to put that shield around that fund. And I may have used the word endowment fund. Most of us think of KU endowment or something that is a separate fund, but most of us don't really need to do that. But create by policy the notion that that's the executive director. Don't think about getting into that and balancing your budget unless there's a full vote of the board. That's enough to keep that separate.
Well, thank you all so much for your time. We are at a time boundary. I see lots of thanks in the chat. Heather from the Douglas County Community Foundation says that if you or your organization would like to explore an endowed nonprofit fund, to reach out to her. And it looks like those are all the questions. Many thanks to Wint from participants in the chat and from the United Way team. We really appreciate your leadership and expertise that you bring to our community, Wint. Thank you so much.
You're welcome. Thank you. Happy
friends,
Friday.
Thank you for joining us. If you have any other questions, you're welcome to send them to me and I will pass them on to Wint. And again, thank you all and have a beautiful weekend. Thank you so much, Wint.